Pleased to say, Kathryn Rooney Vera joining us, I believe, for the first time here in 2023. She's head of global macro and chief investment strategist at Baltic Capital Markets. I still think it's fair to say we can say Happy New Year. It's not that late in the year. Kathryn, great to see you.
Happy New Year, Romain.
Absolutely. Let's get your thoughts here. Not just on today's number on the CPI, but really, I guess, sort of the aggregation of data that we've been getting over the last few weeks here that seems to be painting a picture that the economy is in a decent position and inflation is trending down.
What I'm closely looking at, Romain, is real wages. They're still negative. But if the Fed succeeds in this disinflationary trend towards its 2% target in an environment of real wage growth that turns not negative but positive, that to me is the best case scenario, and that is the soft landing. Yeah. So if the Fed can maneuver that, it historically has never been the case. But perhaps this time is different. And if you listen to Claudia Sahm, who I appeared on with Bloomberg Surveillance recently with, that's her contention, of course, of the Sahm rule. Yeah. When you look at the unemployment rate, which moves higher by 50 basis points or more in a 12-month period, we've never not been in a recession. But so far, the unemployment rate is moving lower.
So if a soft landing, if it's not just a pipe dream, if it's something that we could actually see, what's the playbook there? What does well in a soft landing environment?
Yeah, Katie, so I'm still in the camp of recession and a rise in unemployment. But hey, the chances are clearly moving higher that the Fed is somehow able to land that soft landing. And if that's the case, what's on my radar, I'm still overweight, some of the sectors that were down today, utilities, staples, healthcare I really like, energy. But what's on my radar in the event that the Fed does nail this is those that need to mean revert from last year's devastating performance. Small cap Europe, small cap US, real estate. You had someone on previous to me who talked about real estate. I agree. Some large cap names. So there could be that mean reversion to those sectors and those asset classes most decimated in 2022.
We were talking, Kathryn, a little bit earlier this week with Cam Harvey, a few other economists, and talking about the yield curve and kind of the signals that it's been sending. Of course, we know we've pretty much been inverted, at least on the key yield curve metrics that most people pay attention to. There is a lot of debate right now as to whether that's sending a false signal. And I'm wondering how much stock you're putting into some of the moves that we've been seeing in the bond market, in the fixed income space, as a read-through to economic conditions.
I think they're part of the scenario that we economists should continue to look at. And as Claudia Sahm mentioned, and I agree with this, a lot of these tools are still valuable. We just have to put them in the context of where we are today. So yes, continue to use all of these economic leading indicators that have historically been very accurate in predicting recession, but consider where we are. The Fed has been really keeping rates very low for an extended period of time. They're rolling off their balance sheet. We're probably entering a recession. What does that tell us? I like fixed income in the short end. I think that T-bills, 4.6%, 4.7, 3-month T-bill is pretty attractive when you're considering that versus the dividend yield in the equity market. So I tend to be more defensively positioned for our clients, and I think that there's more potential downside than upside at this juncture, Romain.
And so looking at cash, looking at those T-bill yields, which to your point are relatively high based off of what we're used to. But what about longer duration? Do you see any opportunities when you look a little bit out the curve?
Not quite yet. And I say that because, if we were entering a recession, Katie, and we had the unemployment rate jump significantly, which would curb demand, both private investment and consumption, then we could talk about a Fed that could potentially sound more dovish by the end of the year, even cut rates. But I don't think we're there yet. So I would stay short duration. I would stay in cash and cash equivalents, have a larger proportion than normal in cash and cash equivalents for now, and then start to potentially further down the line, look out 2s, 3s, maybe 5 years. Not quite long duration yet. I would recommend looking into some high-yielding names, which are producing juicy yields in an environment of high commodity prices and a reopening of the Chinese economy.
With regards to high yield, I mean, some people are saying, okay, the worst case scenario might be behind us. Even if we do end up in a recession, even if we do have an economic downturn, that the idea that some of these companies would just kind of vanish, or they wouldn't be able to sort of refinance and sort of, I guess, give themselves a new life, that might be a catalyst for getting back into some of those high yield names. The idea that if we are going to headed towards an upswing at some point soon, that going into that space might be profitable, Kathryn.
Well, there are things to have on the radar. I wouldn't be jumping in them quite yet, but emerging market fixed income, for example, Romaine, is one of the areas where we do see value. And if I'm right, and we get the Chinese reopening and commodities continue to catch a bid, then there are some juicy yields to be had in the emerging market space. So I think these are things to keep in mind. I don't think we're out of the woods yet. I think we should remain defensively positioned, but be ready and agile in 2023 and have your Santa Claus list, I think, ready.
All right, Kathryn, I'm going to have to leave it there. Always great to catch up with you. Kathryn Rooney Vera, she's the head of global macro, chief investment strategist at Bulltick Capital Markets. Even her dog agreed with her.
Yeah, there you go.